Penalties, provisions to counteract unethical tax practices. Illustration 1. Mrs. XYZ liable to tax at 30%. Particulars are given. As per return of income furnished is 50 lakhs determined under section 143 1A 60 lakhs, 143 3 75 lakhs, and section 147 it is 95 lakhs. Can penalty under section 270A be levied? Solution. Under section 143.3 it is taken as 75 minus 60 lakhs is 15 lakhs of underreported income. Tax on this underreported income plus 60 lakhs gives 23.4 lakhs. Tax on this 60 lakhs gives 18.72 lakhs. The difference amount or additional tax payable on underreported income is 4.68 lakhs. Penalty being 50% of this amount is 2.34 lakhs. 2.34 lakhs. Under section 147, it is 95 minus 75 lakhs gives 20 lakhs of underreported income. Tax at 30 plus 4% gives 31.2%. On this 20 lakhs plus 75 lakhs is 29.64 lakhs. Less 31.2% on only this 75 lakhs, which gives 23.4 lakhs, and tax payable on underreported income is 6.24 lakhs, and penalty is 50% of this tax amount being 3.12 lakhs. 3.12 lakhs. Assumption underreported income is not on account of misreporting. Illustration 2. Mr. Ram, age 55, not furnished return of income for assessment year 25-26. Total income assessed under section 144 is rupees 12 lakhs. Penalty under section 270A is attached. Is whether penalty 270A is attached and what is the quantum of penalty leviable. The solution for this: apply new tax rates on 12 lakhs and the tax amount is 83,200. When applying tax rates as for new tax regime, it is 3 lakhs to 7 lakhs, it's 5%, 7 to 10, 10%, 10 to 12, 2%, plus 4% of health and education cess gives tax of 83,200. Penalty at 50% of this tax amount gives 41,600. Note: assume that underreported income is not on account of misreporting. Illustration 3. ABC Limited liable to tax at 25%. Given data: return of income. Income furnished in return of income is loss of 15 lakhs determined on under section 143 1A is minus 8 lakhs, 143 3 is minus 5 lakhs, 147 is positive 4 lakhs. Penalty leviable and whether penalty on section 270 is leviable and quantum of penalty. Solution. Computation of penalty leviable under section 270A. This is under 143.3. Yes. Minus 5 lakhs minus of minus 8 lakhs gives positive 3 lakhs. Tax at 25 plus 4%, which gives tax of 78,000. Penalty is 50% of tax, which is 39,000. Assessment under section 147, this is 4 lakhs minus of minus 5 lakhs gives 9 lakhs. Tax at 25 plus 4% gives 26%. Tax is 2,34,000. Penalty is 50% of this tax amount, which gives 1,17,000 of penalty. 39,000 and 1,17,000. 39,000, 1,17,000. Now coming to test your knowledge questions. Okay. Test your knowledge. Question 1. What is the quantum of penalty that could be levied in each of the following cases? Failure to get books of accounts audited under section 44AB. Solution: 0.5% of turnover or 1.5 lakhs, whichever is lower. as per section 271B. Next, failure to comply directions under section 142(2)A. Penalty is rupees 10,000 under section 272A. Failure to furnish report from accountant under section 92E. Penalty rupees 1 lakh under section 271BA. Next question. X an individual total sales for the year ending 31/3/2025 is 205 lakhs. Not maintained books of accounts for previous year 24/25. Turnover is 28 lakhs in previous year 23/24. AO levied penalty under section 271A of 25,000 for not maintaining books of accounts, under section 271B of rupees 1,02,000 for not getting books of accounts audited. Is AO justified in levying penalty under section 271B? Solution to second question. X is required to maintain books of accounts under section 44AA since his turnover exceeded 25 lakhs in previous year 23/24, and he has to get them audited under section 44AB since his gross sales in previous year 24/25 exceeded 1 crore, and he is liable to pay penalty under section 271A for not maintaining books of accounts. Penalty of rupees 25,000 under section 271A is correct. Mr. X not maintain books, he cannot get the audit done. In Surajmal Parsuram Todi versus CIT, the Guwahati High Court has held that imposition of penalty under section 271B is erroneous, because when a person commits an offence by not maintaining books of accounts as contemplated under section 44AA, the offence is complete, and after that there can be no possibility of any offence as contemplated under section 44AB. Therefore, in this case, AO is not justified in levying under section 271B. State conditions to get relief under section 273A, subsection 4. Can Principal Commissioner or Commissioner refuse to grant relief when conditions are complied? Two conditions. Answer. Solution. The two conditions are payment of penalty could cause genuine hardship to the assessee and Commissioner is satisfied. Genuine hardship exists both at application and at the time of passing order. And the other condition is cooperated in inquiring related to assessment or recovery of any due from him. As per the decision of Andhra Pradesh High Court, KSN Murthy versus Chairman CBDT, the satisfaction of exercise of discretionary power under the section must be based on objective consideration and not subjective satisfaction. Question 4. Examine whether following are liable for penalty. Ram and Associates not deducted TDS under section 194C. Solution. Section 271C. As per section 271C, penalty is equal to amount of TDS deducted and 30% is disallowed under section 40A IA. Hotels were asked by income tax officer to furnish details. They have not furnished in spite of various reminders. Solution. Penalty under section 272A subsection 2, rupees 500 per day. Next question. Fox Limited failed to furnish information sought by transfer pricing officer. What is quantum of penalty? As per section 271G, penalty is equal to 2% of value of international transaction or specified domestic transaction for each such failure. Question 6. What would be the penalty under section 270A? Here are two cases. One is the profit case and another is the loss case. Given Beta Limited is a trading company but its turnover is more than 400 crore, which means tax is 30%. Now coming to Alpha Limited. This is return of income on section 139. As per section 143, 1A is 45 lakhs, 143 3 is 62 lakhs, 147 is 81 lakhs. Assessment under section 143 3. It is underreported income is 62 lakhs minus 45 lakhs gives 17 lakhs. Tax on underreported income, which is 30 plus 4 percentage, which gives 31.2 percentage into this 17 lakhs plus 45 lakhs is 19.344 lakhs minus 31.2 percentage tax on this 45 lakhs gives 14 lakh 4,000, and the difference amount is tax payable on underreported income, which is 5.304 lakhs. Penalty being 50 percentage of tax is 2.652 lakhs or 2,65,200. For reassessment under section 147, underreported income is equal to this 81 lakhs minus 62 lakhs, which gives 19 lakhs, and tax on underreported income being 31.2 percentage into 19 plus 62, which is 25.272 lakhs minus tax on 62 lakhs, which gives 19.344 lakhs. Tax is equal to the difference amount being paid to be paid on underreported excess tax paid on underreported income being 5.928 lakhs. Penalty is 50 percentage of tax, which is 2.964 lakhs or rupees 2,96,400. Now coming to Beta Limited. This is loss case. As per section 143.3, underreported income being here 2 lakhs minus of minus 6 lakhs, which is positive 4 lakhs. Tax on underreported income 4 lakhs into 31.2, which gives 1,24,800. Penalty being 50 percentage of tax is 62,400. Under section 147, assessment. Think reassessment. Underreported income is equal to this 6 lakhs minus of minus 2 lakhs is positive 8 lakhs. Tax on underreported income 8 lakhs into 31.2, which is 2.496 lakhs. Penalty is 50 percentage of this amount, which is 1,24,800. Question 7. Explain relevant provisions and quantum of punishment. SSC not allowed the officer authorized to inspect documents and books of accounts. Solution. Prosecution launched under section 275B. Rigorous imprisonment 2 years plus fine. SSC deliberately failed to comply section 142.1 and 142.2a. Solution. Section 276D. Willful failure to produce books of accounts to comply directions. Failure to produce books of accounts and failure to comply directions, then rigorous punishment up to 1 year plus fine. Next one. SC deliberately failed to pay TCS under section 206C. Solution. Prosecution under section 276BB, rigorous imprisonment up to 3 months to 7 years plus fine. Next question. Assessing officer lodged a complaint against question number 8. Assessing officer lodged a complaint against Mrs. KLM, a firm, for failure to furnish return of income. Tax payable was rupees 60,000. Appeal filed by firm allowed by Commissioner Appeals. Tax payable as per order of assessing officer was rupees 8,900. Assessing officer accepted the order of Commissioner Appeals and has not preferred an appeal against the Income Tax Appellate Tribunal ITAT. The firm desires to know the maintainability of prosecution proceedings in this case. Solution. Prosecution under section 276CC. Tax evaded not exceed 25 lakhs. This is 25 lakhs. Then rigorous imprisonment is 3 months to 2 years plus fine. This section has not attracted to SSC being other than company. where ROI is not filed and tax payable not exceed 10,000. In the given case, SSE being firm, tax liability as per original order exceeds 10,000. Order of Commissioner is 8,900, which is less than 10,000 order of Commissioner. Hence, prosecution is not maintainable. What if KLM Limited a company instead of firm? Solution: yes, prosecution proceedings are maintainable. Question 9. Section 278C. Offences committed by Hindu undivided families. Solution: Solution to question 9. As per section 278C, offences committed by Hindu undivided family, Karta deemed to be guilty. Karta not liable to any punishment if he proves offences committed without his knowledge or he has exercised due diligence. As per section 278C subsection 2, offences committed by Hindu undivided family and proved that offence attributable to any neglect on part of any member of HUF, such member shall also be deemed to be guilty and punished accordingly. Question number 10. Can department launch prosecution where they accepted revised written filed by SSE rectifying a mistake? Solution: Sunil Babu, Assistant CIT versus Steel Processors, observed that since department accepted revised returns filed, there was a bona fide mistake in the original return and there was no element of mens rea. Therefore, High Court held that department cannot launch prosecution. Question 11. Ravinder, an Indian citizen, left India, settled in UK from 10/4/2016. Acquired a property worth 200 lakhs in financial year 2013-14 at Malaysia. A Singh officer came to know of this in March 2025. AO issued notice under Black Money Act. Mr. Ravinder contended that he is not a resident in financial year 24-25. Under Section 10, notice could not be issued to him. Is the issue of notice tenable under law? Solution to question 11. Liable to every SC would be liable to tax at 30% of his undisclosed foreign income of and asset. Liable to tax in the previous year such asset comes to notice of AO. Mr. Ravinder, a non-resident in India in the previous year 24-25, but he was a resident and ordinarily resident in the financial year 2013-14 when he acquired the property at Malaysia. Notice under Section 10 of Black Money Act is tenable in law. Mr. Harshit, question 12. Mr. Harshit purchased house property in A in 13-14 when he was a resident in India for 80 lakhs. Out of this 80 lakhs, 55 lakhs is assessed and 25 lakhs is not assessed. This asset came to notice of AO in March 2025. Value of house property on 1/4/2024 is rupees 120 lakhs. What is the value of undisclosed assets of Mr. Harshit for Black Money Act? In which year it is chargeable to tax? Solution: 120 lakhs into 25 lakhs divided by 80 lakhs, which is 37.5 lakhs chargeable to tax in assessment year 25-26. Question 13. In 1988, in 1988, one second. In 1988, SSC purchased apartment in Country X for 10 lakhs. In 2003, it was sold for 30 lakhs and this amount is deposited in Country X bank account. In 2004, another apartment purchased for 45 lakhs. This deposited amount was used to purchase. Apartment value on valuation date is 55 lakhs. Value of foreign bank account is 70 lakhs. Question: what is the fair market value of new apartment as per black money imposition tax rules 2015? Solution: fair market value exceeds cost of acquisition, which is 55 lakhs greater than 45 lakhs. 55 lakhs is the open market value on valuation date as per valuation report. Question 14. Mr. Pilo, age 72, left India permanently in Jan 2012. In June 2024, he came to notice. In June 2024, it came to the notice that Mr. Pilo had accumulated assets during 2008-9 exceeding 500 lakhs outside India, not disclosed for income tax purpose. Mr. Pilo was served with a notice in August 2024. Mr. Pilo opinion that no proceedings be initiated against him. Income Tax Act under Income Tax Act 1961 and Black Money Act. Discuss liability of Mr. Pilo and procedure and methodology for determination of value of undisclosed asset. Answer to question 14. There is no time limit for initiation of proceedings under black money law. Proceedings can be initiated against Pilo. He is liable to tax at 30% on undisclosed foreign income and asset. Mr. Pilo is liable to tax for asset purchased in previous year. In the asset purchased in the previous year 8 and 9, during the previous year 24-25, during which such asset comes to the notice of AO. Mr. Pilo, Pilo, who was resident in India in the previous year 2008 and 9, would be assessed under the Black Money Act even though he was a non-resident in previous year 24-25. Pay tax at 30% during the previous year 24-25. Undisclosed asset came to notice of Joint Director of Income Tax Investigation in June 2024. Fair market value of the asset as on 1/4/2024 would be adopted. Penalty is equal to, in addition to tax paid, then penalty is equal to tax into 3 times. Value of undisclosed asset would be fair market value of asset. Value of residential property would be higher of cost of acquisition and open market value on valuation date. Value of bank deposits would be sum of deposits since the date of opening of account. Now coming to the last question. Deepak, who settled in California, USA since 2015, acquired residential property in USA on 25/6/2009 for USD 20,000. He kept bank deposit of USD 10,000 in a bank account in New York since 15/4/2010. Notice under Black Money Law, Black Money Act was issued on 2010-2024. Fair value on 1/4/2024 was USD 25,000. Exchange rate on 1/4/2024 is 71. Compute the value of undisclosed foreign asset. Solution: undisclosed foreign asset for residential property, it is cost of acquisition or fair market value on the first day of previous year in which the notice was received, which is USD 20,000 or USD 25,000, whichever is higher. 25,000 USD into rupees 71, which gives 17,75,000, and for bank account it is USD 10,000 into 71 is 7,10,000, and the total value of undisclosed foreign asset is 24,85,000. This is end of this chapter. Thank you.